Great. Good morning, everyone. Thank you for joining us on a Saturday morning, and welcome to episode 2 of HyperInsights. So I have with me today Akshay Mehrotra, who is a co-founder of EarlySalary. Akshay, very happy to have you with us today.
Thank you, Deepak.
We were particularly excited to have you on board because we've heard you talk before, and I'm sure the audience would love to get a pearl or two from your wisdom. So I would like to take this opportunity for us to quickly introduce you to everyone formally, and also introduce EarlySalary to those who might not know.
Started with a very simple premise. We noticed that young working professionals couldn't get an instant loan or credit in runtime, and they had to wait for almost a few weeks to get access to any amount of credit when they wanted from a bank. While we were trying to solve this problem, we noticed there were two elements. The first element was speed of giving money. The second part was really to say that can we build a newer positioning for a product which is not looked at as a loan. So that's why the name EarlySalary got created. It literally means you can borrow your salary a few days early, and you pay for only the number of days that you borrow. I think over time we evolved. Today we have received more than 10 million downloads. We have disbursed loans to almost 1.5 million loans have been disbursed. If you look at the platform, a decision almost 5 million people. And the unique part about the platform has always been the simplicity. Right? It's an uncluttered product. We don't sell too many things. We only give cash as our primary product. Typically, we give you half your month's salary when you come. What we also notice is hyper retention of customers. Typically, we're able to retain 87% of our customers to take multiple transactions with us. An average customer seems to be spending more than 2.5 years with us. I think in the first 2 months, we required 200 people, 170 of them are still with us. It really indicates that once you start a line of credit, it needs to taper quite well. It needs to be rational in pricing. At the same time, as the consumer evolves, you need to evolve with him. So again, giving the example of the 200 people who started with us in the first 40 days of started lending, almost half of their companies are now tied up with us. Because they took the product to their employers and said, listen, why don't you introduce it as an employee benefit? The second part, we noticed that we were almost able to upgrade 84% of them to a larger value loan. So if they started off with a 1 month product, they're now sitting with an average 12-month product. We're also able to bring their borrowing cost dramatically. And more than that, they use us as a transactional finance product apart from their personal loan financials. So if they want to shop something on Flipkart, Amazon, they use us. We see many of them paying their child school fees using our platform. And we have almost had a few hundred employees a month to do skill upgradation. And if you look at, we don't even call ourselves a loan anymore. We really call ourselves a salary advance. And it allows us to really talk to a singular customer type. Yeah, that's a quick introduction to EarlySalary.
Great, thank you. I have a quick anecdote to share about EarlySalary. This was 4 years ago when I had just moved to Bangalore, and there was a brief cash flow situation that I was in. My previous employer had not settled 2 months of salary, and I was yet to get my next paycheck at the new place. And I didn't want to ask my dad for money. So some friend of mine actually suggested that I should just download EarlySalary and take a small loan. And I remember the process being so elaborate back then. Somebody had called me up from the EarlySalary office to do a proper due diligence interview, and then some delivery boy had come to take my signature on a document. So this was 4 years ago, 2016, and I can see how the processes have changed and transformed and become much more efficient today. So just wanted to say thank you, Akshay, for starting EarlySalary. It did certainly help me in a slightly difficult time. And I'm sure it's helped, like you said, more than 5 million people, right? Great. We also have slides up about EarlySalary. So that's great. 6 million downloads. Amazing.
So I think this is quite dated, this slide, surprisingly. So we have close to 10 million and we have 500 corporates. Yeah, I think numbers have grown dramatically, and that's a good part. So good, right? Yeah. Thanks.
Nice.
Akshay, that's a very good problem to have. I would also like to add that EarlySalary is a category creator. Today the fintech boom that we talk about, where it is actually being thought of as a feature, right? Last discussion we were talking about Kunal Shah saying that it's just a feature. I think it is companies such as EarlySalary that started it. And I think they had to go through a whole lot of educating the user, educating investors. I'm sure Akshay has a lot of stories to tell on the category creation part of things.
Yeah, a lot actually. I think I've met more than 300 venture funds to make sure that we raise our Series C over the last 4 years. I think we had a paper seed. We raised money in one meeting and one Sunday. We had a 1.5 million seed that we picked up, but it was a struggle of the next 128 VCs to pick up Series A. Series B again happened overnight without us stepping out, and Series C actually took 350 venture meetings. Right, so it's been it's more the place to make sure you raise money.
And that also, I think if you see EarlySalary, Akshay's experience of 250 venture meeting shows, because I think the frugality with which they are building the company. I was looking at the ratio of loans dispersed to the number of people in the company, and I'm yet to see that kind of a crazy ratio. I think that speaks, and the amount of money in the bank. I think in your story article, Akshay, you were mentioning. So I think every entrepreneur who goes through that pain realizes that they don't want to be doing it again and again.
Oh, absolutely. I think we have not only that, we have not touched our Series B and Series C money is still lying with us.
Awesome.
Because in our model, we have to use it to leverage to get debt. But the good part is we have actually not burned any of our capital for the last 2 years.
Awesome.
That's amazing.
These are rare stories in world today when everyone is looking at, burning out everything they've got in next 12 months.
Great. Kedar, do you also want to give a quick intro about HyperVerge for the audience, for those who don't know?
HyperVerge started out as a research group at IIT Madras. All students at IIT Madras. For the early years, we used to represent India in robotics. And more as time went, we started focusing on real world problems that started exciting us as a team. In 2014, we went to the US and people liked the technology and we got funded. Fast forward to today, HyperVerge has two businesses. One is a fintech platform and one is a geospatial platform. The fintech platform is used by Vodafone, Idea, Jio kind of telecom players. It is used by traditional lenders such as L&T, Aditya Birla, etc. It is also used by fintech players such as EarlySalary, etc. And they use us largely to do the KYC process, fraud checks, and in the digital journey of the customer, there are many places where HyperVerge helps out. Last year, we did 280 million KYC checks. That's, I think, we are yet to hear a number larger than that. So HyperVerge can be called as a leader in this space. We also have the same offering in Vietnam and are now scaling to other countries as well. Our geospatial platform is mainly used by folks such as US Air Force, by Airbus, and they use it to look at large number of satellite images to draw insights out of them, to understand sensitive information with respect to changes that are happening in the world. So we are a team based out of Bangalore in India, and we are also a very frugally run company.
Amazing. Great. All right. Now that both of us have covered the introductions and our marketing teams are both very happy about the promotion that has happened, let us now move ahead and address these questions that our audience members want answered the most. So Akshay, if you see the poll that we conducted at the start of the session, we can see that most of our audience members today are curious about what does the future hold for fintech, right? And although this is a slightly generic question, I think you would have seen around yourselves all over in the ecosystem. Definitely there has been a disruption recently. But my question to you is, A, did you already see this coming before COVID? Did you see signs of worry before COVID in the fintech ecosystem? And B, 18 months from now, what are the major headwinds that are going to shape the future of this industry?
Yeah, I think let's look at the financial services space first. So if I look at the last 18 months, we went through 2 times NBFC crisis, 1 time banking crisis, right? So I think the fintechs were far more well prepared and far more pragmatic in running their businesses over the last 2 years. If you had jumped into COVID without those 18 months of bumps, we wouldn't have survived, right? We would have been all over the place, lending blatantly, not worrying about the crisis to happen. So early indicators of crisis were there for almost a year now. So we saw that with the two NBFC crises became really bad. But when the one of the banks went through its downturn, it was really concerning because it meant that many systems had to be managed in a far more real-time basis. I think the second part, if you look at consumer sentiments, was still very high till almost beginning of this year, right? Which meant the consumer demand was still picking up, while players in the SME categories were far more stringent and they were quite worried. And we saw many of the SME players trying to venture into other businesses. And we saw that across the board, the top two or three SME fintechs started doing a lot of consumer products because they said they can't hybrid the risk only on one line. The second part which also took place was fintechs. I think 3 years back, we were all saying, oh, we need to be asset heavy, then became asset lightness. And I think during the NBFC crisis, we realized it needs to be hybrid culture, right? So you need to have some things on your book, some things off book, and a partnership model needs to exist with banks and traditional players to really service the consumer demand. So if I look at players like us, while we were the first ones to own an NBFC and were always lending off our own balance sheet, but we realized that in the downtime, it's very important to have a partnership and actually lend more efficiently, because you can't raise more debt continuously. So that structure changed and the hybrid structure started coming along. I think today both the things come into picture. So when let's say whenever downturn happens, people switch off lines to any external partner, which means you need to have your own lines also. And today, if you look at in the crisis time, the players who don't have any balance sheet literally were running helter shelter to really make sure that they can either service the existing customer base or at least manage the moratorium issues happening, right? Versus the players who own balance sheet, of course, had a working capital issue coming in because the demand completely disappeared, while you still had to service your own loans and there was negative carry coming in. And there are these two issues which we are facing today. I think if I look at if I just take this step from 2020 to 2021 end, I'm saying I'll expect almost every traditional player to really become a fintech, right? And hygiene will come in any format of lending. Right? It's going to be very difficult to walk into a customer and say, why don't you come to my branch, or can I come to your house to do your FI and do your KYC checks, etc. So that all that step is going to disappear to more digital journey. So and I think every single sales entity will start servicing a similar product. On the second side, on the product side, we already see a lot of competition coming in, right? So the competition coming in from many players outside India who wanted to enter the market, right? We also see the regulator questioning many of the models where high interest rates were being charged or a subprime product was being released in the market. And while today the noise is more coming from consumers, we see the model evolve to say a rational product needs to exist. In the short run, I think everyone will first introduce shorter tenure product before they come out with longer tenure products, because yields cannot be unknown and recovery systems have to be running. So if you look at competition, 18 months horizon, I think every traditional player is going to be doing something similar to fintech, and shorter tenure products would be the flavor of the season.
Understood. Does this then mean that fintech as a space to be in and the product that is being offered to the customers is going to get more and more commoditized over time?
No, see, in financial services, there's nothing as commodity, right? Remember, if you look at traditionally also, the largest private lender in the country or largest private player in the country only has 2% market share, that is HDFC Bank, right? So it cannot be commoditized because the consumer has to be serviced by, the consumer is much larger, right? While today in the next 3 months, demand will get contracted, but consumer is still going to be serviced, and you need specialized players to service specialized problems.
Akshay, I had a follow-up question on the same. Now, when we see the number of banks plus NBFCs, we have maybe about 35 plus banks, and we have almost 10,000 NBFCs. And if you see on Play Store or App Store, the number of apps that are actually there, right, that have a digital workflow, I think that's about 100 apps or less than that. So One question I have is that all of these guys now have to think digital, because you don't want an agent coming to your house, or you don't want to be going to a branch or a kiosk or something in the world that we see, say, at least in the next 6 to 12 months. So are all of these players also looking at working with people like EarlySalary? It means a big amount of digital, workflows that come in, and you start having competition. But it also means that you can start having partners where you have experience having a digital stack for more than, almost 6 years now. So you also get to provide your stack to a whole lot of people. How are you looking at that?
So if you look at, we're actually powering 3 other players already.
Okay.
I'd say let's look at the entire space. Who all is lending? The SIM card provider that you buy is also lending. The mobile phone that you buy is also lending. Uh, the uh, the UPI payment app that you use is also lending. Uh, your bank is also lending. If you open your e-commerce platform, he's also lending. If you look at your players like Truecaller and or mobile identification service provider, he's also lending. Um, if you buy insurance, walk out to a physical retail store, even he's trying to lend. So lending by design is the largest monetization in financial services. The incomes are much higher than doing an attachment product like insurance, etc. So everyone does try to lend. The only part is lending is a very difficult business. In good times, it's very easy to do, right? When everyone is the economy is doing really well, anyone can lend, right? Because person will borrow from one player and repay the other one, and circular money going around. Everyone can afford in that time period. When the market becomes bad, it becomes an extreme precision work, right? Which means that you have to be first. It's not only the giving money is the question. It's about who to give, and how do you build your recovery systems, and how do you carry risk attachment to it, right? So while everyone will now try to lend, they will try to lend more like a marketplace, because to take the risk on the customer is going to become far more complex, right? So specialized lenders will become critical. Of course, there would be some amount of demand contraction. It will open up in some more time. But there'll be lots of players wanting to lend. And we saw that over the last 8 months. If I look at last 8 months, every single mobile manufacturer has got into lending. Right? Every single UPI app has introduced funding or wanting to introduce lending, has implemented tech stacks, right? Every single lender, every single payment gateway has a pay later or an EMI finance product. And of course, the number of fintechs grew. At the same time, many traditional players have gone and powered fintechs to say, listen, we want a share of this pie. We don't have digital expertise, but we do have money. We do have LOS and LMS systems. Why don't you lend on our behalf? Right. And then, of course, there are what you call as classical neo banks, which are white labeling bank services to, again, take a sandwich of the customer who feels is underserved. Right. So there is everyone lending, but if I look at in the short run, fintechs which were not making financial sense, so they were more to customer acquisition only centric, will struggle. Fintechs which on the risk and core business operations front will actually thrive because they have to power many more players. And if you look at and a hybrid culture will exist. So if I look at our success today, when we power others, we have a huge amount of learnings and actual learnings from lending and collecting. So many people say a scorecard can be built by anyone, right? Bureaus can build great scorecards, but they really don't know what was the effort to collect the money back. The new money got collected back, and what was the cost it took to get it back. And that learnings allows a little more risk, a little more or shaving off which customer to keep, which one to retain, to come in. And that's why the models become more powerful. I think we also see that there's a lot of demand for our tech stack to get implemented across the board. So while we did power OEMs, many banks came forward to say, can you power our consumers in some manner? The co-lending balance sheet is also picking up and many partnerships coming in there. And I see that as an opportunity. We also see many fintechs coming to us to say, can we use your capabilities? Because we want to focus at a customer segment you may not want to attract. But can we use your seamless capabilities built specifically on LOS, LMS to manage that customer along with our scorecards?
Right. So the summary of that would be that fintechs that really took their time to learn and which had a good tech stack, a good process, a good team behind them, they would still find this as a massive opportunity because as all of these players look to go digital.
Correct.
Got it. Akshay, the next most important question that is that our audience is curious about is what is new in tackling fraud, right? So on that, I wanted to first ask you, as a digital lender, what is the biggest one or two kinds of frauds that you encounter on the system on a day-to-day basis? And going ahead, what do you see changing in the way that digital lenders deal with fraud?
I think the biggest fraud is income identification by customers. So typically customers say that if they can prove this is my income, I should be able to get credit against it. Right? And we see a huge amount of frauds taking place. So we see bank statements being modified. We see a PDF bank statement, which a human cannot decipher that there's a gap. But when you look, and it's a 12-page bank statement of last 6 months, right? But you can only identify frauds if you see how the PDF was generated from a PDF generator rather than the core system. You can see that the tally, someone made a one number difference, and at the end of the P&L statement, when you go see, there's a mismatch occurring there. It's very difficult for human to actually catch these things. So I think that's one. The second, we see a large number of people applying on behalf of someone else to make sure that because there is no physicality, can they still manage to get credit because of that, right? The third, we see classical issues where while documentation is possible, impersonation frauds has to be identified. So the realism of the picture taken, the selfie identification, the originality of the document, and of course, the fourth is identifying fraudulent behavior. So once let's say a fraudster manages to crack one transaction, he will continuously keep using that to attract more and more. So how does your system evolve to catch it faster?
Right.
So
I have something very interesting to share in that context. And if you let me just share my screen, I will show you what we're talking about. So can you see my screen?
Yeah.
These are 6 people. Can you tell me what's common between them?
The same lady.
They're all the same lady. And these are only the 6 images that we are showing you right now. But this lady was such a mastermind. She had made 300 plus such fake IDs. So this is something we caught at one of our clients, and we use this as an example. And there are actually, she's not even the biggest mastermind out there. The biggest number was 850 IDs that one person had faked. And this was across different ID formats, some Aadhaar cards, some voter ID cards, some driving licenses. So it's going to be humanly quite impossible to track such impersonation fraud.
Yeah, absolutely. Absolutely.
Great.
Akshay, another fun example that we have on the same thing is, case. Deepak, if we can just go back from screen sharing to Akshay.
Sure.
Another fun example is you mentioned about, impersonation or people getting loan on someone else's name. We realized that in Vietnam, wives would be sleeping and husbands would use their phones to click picture of the wife, and they are already maxed out on their credit. They can't get any more credit, and these wives who were sleeping, loans were being taken on their name. And then the AI engines really had to adjust in terms of realizing if eyes are open and things like that. So very funny ways in which I think people
almost when we started off, the first time we got a coverage in the newspaper was about our capability to identify a live-in relationship.
Okay.
Right, where the boy applied on the girl's behalf, right, and they were not married. So, but we could identify the relationship, and of course, how he used to apply was also tracked back.
Okay. Okay.
So, yeah.
Important question on this would be, how would this change in COVID time, right? As in, how do you see fraud as a dimension changing during COVID times or post-COVID as we recover?
Maybe I'll do a screen share. Give me a second. I'll show you a slide which actually uh, we have been trying to puzzle with this to say how life will get impacted. Just a second. Pull it out. Yeah, so if you can see, so we're a very simple lender. We only operate in 18 cities, and you can see this was pre-COVID. How exactly customer base was spread over. This is Feb end, right? This was 2 weeks back. Our customers where they are currently.
Okay.
So we felt that immigrant went back home. That's not true. The normal white collar employee also went back home in the fear of COVID, right? So we thought that state borders were closed much earlier and people wouldn't have traveled. But this indication just showed within a 15-day window, uh, 1/3 of the entire population has moved across to every city. So you need from going from a 18 city collections capability, 223 city collections capability. I think that is one of the largest works will actually come into place. Because once you've reached there, now you can't come back. Now they become extremely stringent. Right. So, and people have accepted the part that work from home, at least for half of the country, is going to remain a problem for next 6 months. Right? Which means that as the moratorium impact gets over, how do you go and now collect the money in smaller towns? And location analysis is going to become extremely complex. And for a traditional player to even to populate this data in runtime is extremely difficult. And I think that's the power of fintech and how you look at this data in the right manner so you can power your collection infrastructure.
Amazing. So when we just spoke about collection right now, Akshay, I wanted to hear your thoughts about how you approach collections. So I saw that you have increased your physical collection centers to 23. And this looks like a sort of hybrid model where you're also getting into offline collection. Has that helped in increasing collection rates? Because I see that EarlySalary has extremely low delinquency rates, right? How has that helped, and do you see this strategy being adopted even going ahead now?
So let's split the part into two components. One, how collections is managed, right? So there are two components. One is building systems to set up collection instrument when the customer is borrowing. So I think we were the first players to implement digital SI, NACH, etc. on the app, and they've been running for some time. Almost while we don't make it compulsory on the first loan, subsequent loans we make it compulsory. We noticed that almost 60-70% of our customers do set up because of the ease of setup of the repayment instrument, right? Rather than the complexity of it. The second part has been that you need to be extremely soft when you collect upfront, and reminder systems have to come. Most people don't set up automation reminder systems, right? So making sure a customer gets a pre-X IVR or a pre-X SMS notification to keep money in the bank, and also identify consumers who frequently miss transferring money into the right account. Right? Also, many customers we used to circular money. That means he'll park money from one account, removes to the other account, pay one EMI, take money from a second one, pay the third one. So how do you identify those customers so that you reach out to them in time how they should manage their life a little bit better? And these were the two things that we did. Third part was, if you look at, we always maintained our soft collections call center in-house. The first big hire that we did internally was a head of collections before we gave our first loan 4.5 years back, right? Which allowed us to build a full infrastructure internally, right? Then working, so if you look at, there are almost 250 people needed in call center to collect the money. It doesn't mean that we should house them in-house. The soft ones had to be in-house. So first 24 people were warehoused internally so that we can support whenever a customer team needs. At the same time, our entire contact services, which includes managing new customer retention, etc., was trained on collections always. Right, so that in case we need to lend, we can manage that customer in a far more precise manner, and we can run it in a clean structure. So if you look at today, when collections is becoming a huge issue, FPDs have doubled, etc. We have been still fortunate. Our FPDs are only doubled. I hear in industry most players are at 4 to 5 times. FPD is first time default, right, or the first day default. we were able to ramp up our call center from 24 people to 74, right? Which meant our every available hands moved in a capability to call. They were already trained, so there was no problem there. Of course, there's no demand for money, so sales oriented or welcome callers can move in there. The second part was supporting our third-party infrastructure. So while external call centers who actually call up the customer and are hard recovery people, they also are supported by feet on ground, right? The biggest problem they faced was they didn't have infrastructure to manage work from home. So leveraging your infrastructure so they can log in and they can still call up customers were critical. So many of them, we actually said, no problem, we have remote dialing through phones and tablets, use our services. Right, so you don't have, so that we can still maintain the number of callers. If there were 240 people used for calling, there's still 250 people used for calling. That infrastructure is maintained, right? And we can still manage, and that's why collections is still there. Of course, I would say people who are already in core default, that has literally paused because there's no hard collections happening. You can't visit the customer house, but that will open up. The idea is that how do you work very closely with your partners to micro help out there. For example, if the collections person is in a specific geography, can he get his nearest customers? Can the cases assigned to him are not on aging basis, but nearestness to his customer, so that he can almost walk to the customer if the collections has to be done, and you can still manage infrastructure.
Right. So this is just like the traveling salesman problem. This is a traveling collections agent problem.
Absolutely. Absolutely.
Got it. Great. Akshay, thank you so much for answering that question. We will now open up. So time check, we are at 11:35 and we will have 25 minutes more. And I want to spend this time for our audience members to ask questions that they can then get addressed by you. We'll do a brief screening of the questions to ensure that they're relevant to the forum here. So there is a chat section in the Zoom webinar right now. And if any of you have any questions that you want Akshay to address, now is the time to enter in those questions and we'll start addressing them one by one. Great. Saurav Mehrotra from Hora has asked a question that the market for unsecured loans, especially personal and cash loans, will boost up like anything because of the side effects of COVID-19, whereas market for secured loans such as auto loans and home loans will decline tremendously. So he's asking if we agree or disagree on this.
Saurabh, is the other way around. See, personal loans are demand is created because of discretionary spends. See, today the consumer sentiment is extremely low. So you're not going to run to buy a new TV, a fridge, a washing machine, or shifting into better homes, etc. So technically, demand will first contract, then the demand will come back. Also, people who are wanting money are not the type who are already facing financial issues, right? So there's a blend which has to be maintained. Of course, the demand for auto, homes, everything will come down because there is lower cash flow in the market. But demand will first come back in this, where little bit splurging will start taking place. Let's say your phone goes bad, you need a new phone, you need to still maintain a decent livelihood. So things like those will get spent out. So personal loan will be first to come back. Housing loan will be last to come back, and that is true for anything to do with discretionary spends.
Great. So Piyush asked a question about what are alternate sources of data for credit risk assessment. And I think Akshay must be smiling when he sees this question, because we've read a lot about EarlySalary's social scoring algorithm. Can you tell us a little more about it, Akshay?
Yeah, before I jump into that, I'll answer the question differently, Piyush, because the traditional scoring systems are going to be under extreme pressure. The bureau score actually is going to be a very difficult to answer, because if the customer took moratorium, nothing shows up. How will bureau report moratorium? How customers in this cash flow will be very difficult to adjust. For example, did you lose your job currently, or what was your 3-month-old job salary versus now? How are you managing cash flows? Those questions are not going to be available in the traditional world, right? That means alternate data is going to become very important. While I would say our own scorecard has really evolved. I think 4 years back, we used to ask too many things and look at too many data. We've actually stopped most of it. Today, the data is more metadata, how you behave on the app, how do you fill the form, what is your finger movement while typing. So things have evolved, right? And they're not just your traditional variables. For example, sentiment of picture analysis, etc., is also captured somewhere at the back. Uh, but I would say variables which can help identify customer spending pattern is going to be one of the largest variableness there. And secondly, proximity and how the customer movement is taking place will come into alternate data coming in. So alternate data is going to be more important for the next 1 year than traditional banking data or traditional bureau data, and lenders will have to use these for judgments, etc. Right. At the same time, one part that we should not fear an alternate data. Many players have actually moved away from consuming customer private data. I think that era is over. The quality lenders moved. Like the variables I talk about are not about any private data getting consumed. They're really metadata where we have figured out what makes sense over time.
Akshay, and you have brought out a very interesting point that I think in most of our talks wasn't covered. It's always like what the person is doing on social media, here, there, can we capture that? The behavior of the person on your own app, has so much to tell about that person, right? As in, we have heard about this, we have not worked on it per se, but we have heard about how a person types their own name. And so many things have a lot to tell about that person. Any funny stories, interesting stories you have for because I think that's a very interesting topic you have touched.
So I think date of birth is one of the most obvious ones, right? So when you end up writing your date of birth, uh, you end up answering it correctly when you just type it, and when you realize, oh, I need to pass the system, let me correct it. It also shows the relevance to fraud created in the KYC document. Mostly people enter date of birth and then go see the KYC document and go and edit the date of birth. That relationship is extremely interesting. The second is speed of filling the basic form details, right? A person who can fill it really fast is not remembering the address which has to be correctly fed, right? And that becomes a singular part timing. How fast can you fill up your form? Second, also we see proximity to others in that location filling the form up. See, today almost everyone is sitting at home. That means they have more time, right? So also at the same time, the balance culture of work is changing. So earlier we used to say, when in office people have better internet, that's why they'll apply for loans there. Now that home, their application forms changes and they're still going to apply in a different manner. So how agile are your systems to manage some of them, right? And can you look at those behavioral trends to really identify people better?
Got it.
I see a large number of questions coming on collections. So yeah, I love to answer some of them because these are these are the today's big problems. So Mahavir and Sunita both have given about collection strategy. Yeah, we do run a collection scorecard. I think that's one. We were one of the unique players to run one, which allows us to segment consumers, who to first focus, who not to first focus. The second part is really to make sure that in the collection strategy, uh, you have to have the capability to ramp up and ramp down. And I personally don't like the collection strategies say we will have two collection cycles, either you people between first and fifth, fifth and 10th. People will structure everything in those two collection windows. What actually results is puts a lot of pressure on your team to front end the entire calling rather than spread over a entire month, which means you need more callers in the beginning of the month than end of the month, and some of the structural issues take place. I think you need to balance as per customers' capability to pay. So there is no fixed date of repayment. They should be linked to his salary. So for example, we try to collect within 42 hours of you earning, getting a salary delivered to you. That means we read which day do you get your salary over the last 4 to 5 months, and then give you a repayment date which is closer to that date. That means the collection infrastructure has to be built around that also, how to manage collections there.
Actually, funny you have mentioned that because most of the credit cards that we have, most of these, we see these weird dates coming in, right? Like 26th of a month is the last date to pay. And every time we used to have a segment of our people who always would reach out for a salary advance of some coin, saying, and these are teammates, so you always give out that salary in advance. And we realized that all that pain was happening just out of the collection date. So I think if everyone learned this lesson and created collection systems 48 hours after salary gets in, I think that would be a much better world than people having to run around.
Yeah, but that's one of our biggest business model, paying your credit card on time because it's more expensive than us. And a single large use case why people do come to us.
Yeah.
Interesting. Interesting. Akshay, Saurav has a question that says, do you feel this is the ideal time for fintechs to go out and capture the unsecured loan market? And this actually brings me to a larger theme in general. There are more than 10,000 NBFCs in the country, right? And if we see the number of them that have adopted fintech-like strategies or that have even gone digital is so limited, right? Do you have a hypothesis about why these 10,000 players have not even gone digital till date? And what are the challenges ahead for them to go digital and adopt fintech-like strategies?
I'll disagree. I think some of us feel MFIs are not digital, right? They are the most digital infrastructure possible. Remember, they give ₹100 loan and charge over the next 10 weeks and still recover our digital infrastructure. It can't happen without digitality, right? So first the myth, there are 10,000 NBFCs and why only 100 or 200 of them are fintech, why all the others? Because they're servicing a very different demand. Some loans cannot be done digitally and they need the physical touch to analyze the customer more. The other part to Saurav's question is it a great time for fintechs to go and capture the unsecured market totally? So sort of the problem today is there is no demand for unsecured loan in COVID. Once it's get over, it will come back. It is very frugal demand there. At the same time, if you look at the number of consumers fintech players were catering to in count of customers versus let's say actually being loan given, almost 67% of demand were digital. Right? And these trends were available on aggregators last 2 years that almost 67% of all personal loan demand were getting originated online. Servicing the question online was the big question. Right? If you look at sort of your own case, when you want to take a normal personal loan, you will like to do everything digitally, but the banks kept insisting that we want some amount of physicality because of the risk system that they were running in. Right? Fintechs were willing to take risk on a segment of consumer, and that's what they were able to grow also. But a hybrid culture will come in where banks will partner fintechs to say, if you have the consumer, if he's okay to digital, can we servicing him end-to-end digital will be the right way to look at it. And we'll see that trend picking up. So I would say fintech will move from singular product and ownership of customer to more into the platform play. That's a good question. Do we lend at the same rate pre-COVID? Yes, Sunita. Unfortunately, we have not reduced the rate yet because we haven't got any benefit from our lenders to reduce rates. Unfortunately, in B2B space, NBFCs did not also get any moratorium relaxation, which meant that we were not able to reduce any rates to our consumers. The good part is we didn't increase the rate, right? This is not a loan sharking format. You cannot increase your rates because that's not the right way to look at it. And you can't be opportunist here. We had to increase our threshold. Let's say earlier, if we were okay to lend to a customer who was earning 18,000 rupees, we had to increase that threshold to, let's say, 25,000 rupees temporarily. Right? So the threshold had to be changed. Not everyone is getting approved today. Many customers are told we are not currently servicing your segment. That's because the risk is still getting, the credit risk models are still evolving. Like I mentioned, on the scorecards which ran till 19th of March are defunct. Right? We had to evolve almost 9 new scorecards literally on war footing. And currently the scorecards which are currently running are dramatically different and they're able to cater to that customer.
Got it. All right.
I can
so your answers are fabulous. So I think the number of questions are increasing. we would need, I think, Deepak to help and moderate a little bit.
Correct. Correct. We have a very interesting question from Monish Jaiswal, who asks, how will NACH mandate registration process, especially physical NACH, etc., evolve in a post-COVID world where, you know, a personal interaction will become a challenge?
So, Monish, NACH has already been digitized a long time back. So it's been almost, the only part is Aadhaar-based NACH paused. The offline SI came in, while the other format where you can print, scan yourself and upload has a running functionality of NACH running in. So most fintechs are using that functionality almost. So if I look at, I would say, let's say in the month of July last year, we used to pick up 80% of the NACHs in the market, right? In month of Feb, we only picked up 30% of them. So almost 70% customers were able to set up repayment instrument on the app without any painful work. We are waiting for Aadhaar regulations to get, which got restructured mid of last year to get corrected again. If that comes in, it will really improve life. Specifically, one is for NACH setup using Aadhaar. The second is KYC using Aadhaar. And third is video KYC. I think if these three systems come in, like many of the classical banking attachment products that fintechs were trying to sell out, having a real struggle there, because the bank KYCs or selling a bank product means full KYC to be done, which makes it very difficult. And that will be that's where the next focus will come in. But NACH is fully digitized. There's no problem. There is an evolved product there. We've taken this question of Debashri, which is quite interesting, which is about RBI should see digital banks coming in. I think that's one of the real lobbying which is needed in the market, right? So if I look at US as the first country to actually give a fintech license and a full-fledged fintech bank license, right? Where first time a fintech is actually launching a full-fledged digital bank. And India needs that to be done. Of course, the restrictions are fairly large. You need to have large amount of capital structure, you need to be Indian warehouse, etc., to get a banking license. And the complication of managing a bank is very large, right? You need to, your balance sheet size has to become large quickly. Only then running a bank becomes profitable. So I think that would be a great way. I think two things RBI has to do. One is, of course, come out with a clearer policy. The second is to really help raise capital in that such manner also. So if you notice, the last time bank licenses were given almost 10 years back, where or 4 years back, where you had payment bank licenses opening up. The question really is that how fintech banks have to be dramatically different, and how they can build a positive AUM business, yet bring in frugality in operations. And structuring will have to be coming in from the regulator, which is extremely important.
Wow, there's been a burst of questions. Just taking a moment to...
What are the qualities a lender should, or a lending company should have to recover from COVID and this time period? And it's a very good question. It's very relevant, Monish. Sorry, Chinmay. So Chinmay, see, lenders by design have to have two filters, right? One, there has to be someone holding fort at the back, and I call them the risk teams. So in my case, I have two risk specialists. One is Ashish, who's a co-founder, and he's also a macro risk expert. There's Vimal, who's our micro risk expert, understand unsecured lending in a great manner. So these two people have to pull the ship back every time, right? And these in today's market, aggressive salespeople like me have to really start listening to them and say, okay, I will not be too aggressive. We need to control who we are lending to. Sometimes you feel bad. I'll give an example. I am very wary of tweeting anything in public. Like, for example, we have just launched employee and customer welfare program, where employees can contribute or customers can contribute, and EarlySalary will contribute equal amount. But I'm just not able to tweet because so many customers are putting their anguish that we are not servicing them. Right? Just to highlight, there are only 2% people that we have not allowing to stay with us, right? Because they were the most high risk customers. But almost every one of them is revolting to say, I believe I'm a good customer. Why are you blocking me? right? But unfortunately, it's a real situation where you need to be more pragmatic. You need to be sure that the people that you're lending to have capabilities of paying back. Just because you feel you have capabilities doesn't mean in 6 months time things can go wrong. And that's why your risk teams have to do both micro risk to judge that customer and macro risk to judge that portfolio. Will that portfolio recover money at a portfolio level? And that's where the big evolution will take place, where if your risk teams are not strong, you will see those companies, forget about fintech, but classical banking and financial lenders will disappear who don't have implemented these quite well.
That was a wonderful answer. And we spoke earlier, Akshay, and you told us about this macro and micro risk. This two-prong risk assessment approach has helped you a lot in early salary as well.
Yeah, absolutely.
I think we'll have to get Akshay back on our platform again. I think in few days time, maybe in couple of months, because his answers have so much good structure, right? And then how do you set up something? I feel we are going to receive a lot of requests for the same. Akshay. I think be it collections, be it risk, you have been opening up, in terms of structures.
Question from a past entrepreneur like myself is these must be extremely uncertain, turbulent times for you and for your company. How do you maintain such calm composure amidst all this chaos, Akshay?
I think I've done two things. One, I think interacting with each and every member of the company. So we call it ES family. So I think the only way we will succeed is all our people are still able to diligently work and feel motivated, right? So I think that's the first principle that we try to follow. There were at least 16 employees who were facing extreme difficulty because they were living in a blocked area or living in a PG where they didn't have kitchens. How will they cook? So and really being up there in the first few days to making sure we shift them from those areas into or share our homes with them so they can come and live better. A few of the employees were having difficulty to even arrange groceries. How do we work with NGOs to deliver that to them? How do we make sure so unlike most companies where they implemented work from home when the government announced, we implemented work from home almost on the week 1 of March, because the difference between micro and macro is the macro risk people raised their arm and said something is going wrong, office needs to work from home, right? And building the infrastructure made the difference. I think the second part is really uh, making sure you're fully aware of what's happening. There should be no areas where awareness is missed out, right? Third, I think we're still evolving there to have a clear plan, right? So I think every few months we share a plan with our team. On Monday, we shared a senior management plan with our structure to say this is what we are going to be working on, and this is exactly what going to be achieved, right? Some of them took it and said it's like 5 times lower than what we wanted to do a month back. What happened? But that's the fairness. If they're fully aware what's happening, they're far more comforted.
I think we've had
And
similar conversations and similar episodes in our team as well. And what you said, we can deeply resonate with what you've just said.
And of course, I think the last part is you have to give back to society. I think the amount of work that we all need to do has to be much larger. If you only are inward looking, it's very difficult to survive today's times. You have to be outward looking.
Definitely, definitely. Wow, I think Kedar and I need to hang out with Akshay much more to talk
Yeah.
about this larger aspect of contributing back to society. We'll definitely catch up on a different forum, Akshay, on that. Um, Wanted to quickly point out that we have circulated a poll about how satisfied the audience feels about today's interaction. And Akshay, I must say, you have an infinite NPS.
Thank you. Good, great.
And at least half of our people are walking back saying strongly, yes, they've gathered a meaningful insight today from this session.
Like SBI cards that is here today. We have Neo, Nira, we have MoneyView, we have London Club, we have L&T Financial Services, Karza, Home Credit, Happy, Finbro, Fair Money, Experion, Early Salary, of course, HyperVerge team, also Capfront, Cash Plus, so Credixo. So Akshay, I think a whole lot of big participation from the ecosystem, and I think ecosystem giving this kind of a verdict on your talk is amazing.
Yeah, sure. And I would say thank you everyone for patiently listening to all of us. In case anything that we can do to partner, help in any manner, I've given my email ID. Please reach out. I'm happy to connect with all of you.
On that note, thank you everyone for joining today. We come to a formal close to this session. We will keep you updated about any such formal, any such future sessions, and hope to have you back again. Wishing you all a very happy weekend, and signing off now. Thank you so much. See you next time.